Now, Life Healthcare has reported a 73.4% jump in total headline earnings per share. This thanks to healthier margins from the group's Southern African operations in the second half, mixed with a dose of a near tripling in revenue from its life molecular imaging business. The health of the balance sheet has allowed the company to hike the dividend by nearly 15%, along with declaring a special dividend. A company CEO, Peter Wharton-Hood, joins us with his assessment of the performance. So thank you so much for your time, Peter. Now let's actually start off by you framing the year that was for Life Healthcare.
A story of halves, a very difficult first half characterized by an extremely difficult first quarter, a very strong second half where the previously announced strategy around being the preferred network hospital provider started to get traction, and we saw an increase in paid patient days and a strengthening of our presence in the marketplace in that second half, which was also supplemented by the significant transaction that we had in Life Molecular, which also had a great result in the number of Neuraceq doses sold. So all told, a good year.
I see that there are different growth levels between the divisions, hospitals, complementary services and healthcare services. Is that just maybe speaking to the kind of trends that we are seeing in the healthcare space and demand?
No, I think that it's representative of what happens in the acute hospital settings. I think that was anticipated. The disappointing outcome in the healthcare services division was largely as a result of Life Nkanyisa losing two rather large contracts with the Gauteng Department of Social Development, which were not renewed, and that hampered their earnings in the second half of the year.
In Southern Africa, because we know that the macroeconomic environment is quite shaky at the moment, as much as there is a positive sentiment, but there still isn't solid, sustainable economic growth. Would you say that your business is shrugging off the macroeconomic challenges that consumers are dealing with at the moment?
I think that the healthcare business is always seen as slightly defensive in that human beings' propensity to get sick is not correlated with economic outcomes. It's a completely different driver. What does drive in the healthcare business is when economic success is there, we have more medical aid insured patients. So the population grows as economic prosperity improves. So I think the underlying trends have been tough for the industry over the last 3 or 4 years. And we don't necessarily see that abating. Those challenges will be with us for some time to come. It's how well we operate within those challenging moments that will define our success.
Let's actually talk about your margins there, because I did notice there are a few areas of softening. Just talk to me about the drivers of that, but also really how your margin management is looking like at this point.
Our margin was hampered primarily in the instance of a depletion in the health services business, which we spoke about a little bit earlier. Our margin was also shortened somewhat by the increase in management incentives that were paid out as a result of the significant outperformance that the company had during the course of the year. And there was also some margin pressure in the top line as we gave away some of our margin in the network deals in order to attract more volume into the system. So all three of those are under constant management and scrutiny. And as we invest in our complementary services business, which are necessarily higher margin businesses, we feel that we've got our handle on the tiller, and we've got measures to take control of that.
I do note also that you have been on an effort of portfolio optimization. Is that continuing, and really what will determine the ideal portfolio mix?
Well, ideally what we want is to get all our hospitals into an occupancy level that is at or above 65%. That would be a perfect outcome. And in a rather complicated slide, which we put to shareholders and stakeholders earlier today, what we're showing is a decreasing number of our beds having less than 60% occupancy. So we're starting with the basics to try and make sure that we improve the occupancy at bed level. You lose quite a lot of the nuances when you start aggregating it at hospital and macro level. So it's back to basics, and it's concentrating on those units that have had some challenges, either because the towns in which they are depopulating, in which case there's a reduced demand for services, or in some other instances in very popular spots where competition has arisen and they've taken the business away from us. So there are a multitude of factors that contribute to the challenge. And we feel we have to address them case by case, hospital by hospital, ward by ward.
All right. Well, Peter, I mean, as we enter the next financial year, which you are in at this point, what are the short to medium term strategic and operational focus points?
Well, what we have is we've telegraphed to the market that we think in our acute hospital settings that paid patient days will grow between 1 and 1.5%, which is a strong outcome given the 1.6% growth that we've already shown during the course of FY 2024. We've also committed to significant capital expenditure. We'll add 79 new beds to our existing hospital complexes, mainly in ICU. And we've also announced that we'll be developing a brand new 140-bed hospital in the Western Cape region, where Life Healthcare has been underrepresented for years. So all in all, we can see complementary services expanding through PET-CT and imaging. We can see strong growth in our PPDs as forecast, and a capital expenditure program that's outlined around some growth opportunities which we are positioned to take advantage of.
All right. Well, thank you so much for your time and giving us more insights on those numbers that we saw earlier on coming out from Life Healthcare. Peter, that was Peter Wharton-Hood, CEO of Life Healthcare.